20 years ago, I've developed this concept of quality value unit technical, QVT. And that was the concept. What is the quality? What is the knowability, the cash flows? What is the value? What are you paying for the metrics of value? And then is the market recognizing it? And that has not changed over 20 years in terms of that general way of thinking, in my mind, has not changed. I think how we implement that has changed over the years. You know what I mean? The information has changed. And that's the thing about the markets. Markets are like a biological ecosystem. They're always adapting and changing. And there's basic precepts, like if you look at evolution, there's basic principles to evolution. But if you're not adapting, then you have a problem. I mean, there's three main steps to any system, and one would be the creator, and that creator needs to actually be, looking at the system in terms of how it is adapting and making adjustments. And then the other one would be the execution of it, or the kind of the pace, the day-to-day of getting the system doing what it should do. And then lastly, there's this kind of the regulator, and that's, like we talked about, regulating and monitoring a mechanism that makes it stabilized. We need a stabilizing mechanism. You put those together, and those concepts come from biology. JP, today we want to talk on this round 2 here today on evidence-based, an example of evidence-based processes. So we talk about evidence-based investing all the time, and the concept is basically to think like a doctor or think like a scientist when you invest. If you think about how the scientific method works, it's basically you have a hypothesis, you do observations, and then you test your hypothesis, on data, and then you compare your results versus what your prediction would have been, and then you say, okay, does this meet a statistical significant test? And that's doctors do this. They do this with all sorts of practices that they do, so that they can have good protocols and best practices on how they do medicine. And that's something that we do as well in our field. And so what I wanted to do is talk a little bit about a couple of technical factors. Now, this applies to fundamental analysis too, but since we just did a couple of technical factors recently, I thought maybe we would just go over that, JP, and maybe you can walk us through some of the processes that we use, just the process itself, and then maybe we can talk about the results of these 2 technical factors we looked at. To start off with, what is the overview of the method that we're doing? Maybe that would be a good place to start.
Yeah, so the process that we employ is roughly referred to as backtesting or factor backtesting. And the beauty of using more of a quantitative approach to investing is that we can do that. Even though you may not have been running a certain way of picking stocks, in reality for the past 20 years, we do have data that allows us to go back and simulate what decisions we would have made back in time, using historical data, and see what something, like the factors we'll discuss today would have done over time. So that's really this idea of back testing, right? So we are testing something on data, and handling, we can get into the more technical, or there's a series of problems we have to make sure we address to make sure that our results are valid and credible. But basically what we do is we pick a factor, we define a factor, such as, some of the technical factor we talked today. Let's say we talk about a percent from high, for example, and we said, okay, if I were to select stock, I would take a universe of stocks. So let's say we take the S&P 500, we take all stocks in the New York Stock Exchange, NASDAQ, whatever, right? So we have to define a universe, an investable universe. And then we apply that factor to that universe, and then we rank companies. It's that simple, right? So you take whatever factor you have, you look at these companies back in time, you rank them, and you basically said, okay, your assumption or your hypothesis is that the companies on top, who have the highest value for that particular factor will perform better than the ones at the bottom. So that's basically the hypothesis that you're making. So what you do is you rank stocks, and then you build groups, and we call those quintiles. So you break it up into 5 buckets. There's the top quintile, which is your best companies. The second one, third, fourth, and the bottom. The 5th quintile is your supposedly your worst companies, right? So, and what you do is you basically now look at what is that basket or that first quintile of stocks. How do they actually perform? So you said, okay, if I had ranked these companies on January 1st, 1999, and held those companies for a year, for example, how is it true that the basket made out of the top quintile companies did better than the companies that are in the 5th quintile at the bottom of the ranking? And you do that over and over. So basically, that's why we need very powerful tools to do it. So you do it every year, every month, and you go as far back as you possibly can to capture different markets, different so bull market, bear markets, recessions, to see how it happens. And then you look at the results, and you said, is it true that these portfolios, this factor works over time, and that it is a valid way of selecting stocks versus a benchmark? So this is really the gist of a factor backtest, and that gives us some evidence that this, at least all we can conclude from that process is that this particular factor does or does not, is a good predictor of forward return over a certain universe of stocks over a specific period, right? So your conclusions are not, general. We cannot generalize.
It's not universal.
It's not universal. We cannot generalize that. So
it's just like social science or biology. I mean, people that are into biology field do the same thing.
Exactly.
I mean, when they're thinking about, evolution and all that, it's a game of probabilities. Since you don't have a full population, you're taking a sample. No matter what you do, it's always a sample. And you're also dealing with human nature, which is a social science, it's not a perfect science. But what it does do is it gives you a basis and a hypothesis that you can test. And for reasonableness, to see, do we have a reasonable basis that if we took this approach, it should work in the future?
Yes.
And that does, we know that the past and the future are never exactly the same, but we do know that there are factors that have historically shown to have done well and have worked well in real time for many real investors. So, and I think that's a really good way to go about it. One thing I was going to point out was that this methodology that you talked about is a great methodology. There are more than one methods. There's a ton of different methods. And one of the things that's important about doing this is to do what's called validation and replication. So what we recently did a replication of 2 tests, and we're going to talk about that today. So I used a different methodology where we were doing more of a trader type methodology, where we have signals and executing signals over the same universe, or a very similar universe actually. And then we basically compared that with transaction costs and everything else in timing, and optimize those parameters over many, or I should say, tested over a lot of different parameters, and got different results. So I saw some results using that methodology that had a couple of technical factors that I thought they looked really good, and obviously we've been using these for a long time, but they continue to work throughout time. So I was like, JP, let's use that more of a kind of an academic methodology, which is this deciles or quintiles or whatever, using that bucket approach versus kind of a technical trader's approach, and see if we're getting the same result. And if you do, then you have a high validation, because the actual metrics that are used in these different methodologies are different. One's has information coefficients and t-stats and all that, and the other has more like trading type stats. They both have some trading stats in there, but there's not as many trading stats in one methodology versus the other. There's not as many probability type calculations on one versus the other. So they both, I think, help each other, because you can have like the academic way of doing it be more, give you more like an information coefficient, but then that doesn't translate into actual results in trading. Or you can have something that worked in trading, but doesn't work in the other way. So you have to, I think it's a great way to do that. But my point was validating and replicating is super important.
And understanding every moving part, right? You said a lot of very important things in this. Is well, it was great in this case that we worked in isolation and came with our results and confirmed each other, which was great, right? That gave us tremendous amount of confidence that there was not a big problem or a big error in those tests, right? That's the one thing that we live in fear, is the fear of data mining and overfitting and all of those things. So that's why we try to do something the most basic. So what I described was the process of, well, does this factor in its purest, most basic form, does it seem to add value? Does it work? And then you start layering some of the things that you say, like, portfolio construction and trading and real world things. And by nature, by the very nature of what you're doing, you will probably move away. Well, you can improve. Hopefully that's the case, but you might actually, your results will differ from these more theoretical results that we do when we do backtest. So, and then
there's a concept. There's a concept out there of you trade what you test and you test what you trade. And so one of the things is that when you're looking at the deciles, is it's making kind of an assumption based on a calendar, typically. Whereas the trading methodology is actually more kind of like simulating an actual trade.
Mm-hmm.
So, but it has its own flaws. So that they just reinforce each other, let's just say. But so maybe you can dive in a little bit about some of the stats. I mean, I was looking at some of the reports from the output that we have. I mean, let me just jump in really quick and grab that. I was looking at all the factors. Basically, let's just start off with percent from high, since you were talking about that. And basically, that's just a moving average of the price to smooth out whipsaws in the price. It's a very short-term moving average, and comparing how close the stock is close to its high relative to many different time look-back periods. And it's pretty well known that intermediate term parameters are best in this kind of a factor. One of the things that you have in the reports and that you generated that I was looking at was the IC, information coefficient. Maybe you can explain what that is.
Yeah, IC is a fancy word to basically to capture. It's the correlation between your factor ranking and the return, the forward return over whatever period you're looking at. And that's basically, the one metrics that is the success. So you want positive information coefficient, basically that the rank, if you were to rank companies by percent from high, and 1, 2, 3, 4, 5 until, let's say, 500, and then if you assume a holding period, let's say of 12 months, let's say I'm going to rank on January 1st, hold these companies until the end of the year and look what the returns of each companies. So if you were to look at the ranks at the beginning of the year based on your percent from high, basically the top ranked company being the companies closest to their highs, and then you were to rank their return for the next 12 months and basically rank the returns 1 through 500. And then if you just did a correlation between this original rank and the return rank, and it's going to give you a correlation, right? Which is going to be between -1 and 1. So it's bounded. So you want it to be positive so that there is a positive correlation. And just to give you a sense of an order of magnitude, I know depending on the science, I know in health science, sometimes they don't take any correlation that is less than 0.98. They think it's junk. Well, in the case of finance, unless you have a crystal ball, the ICs that we are looking at are much less than 0.1. So not, so 10%. So we're not talking about a very powerful, successful factor may have a 0.1 to 0.15 IC over
What's the
over
highest
the long
IC
run.
what's the highest IC that you can remember you've seen, and what was that factor?
Well, over the long run, again, they never get above the 0.1 to 0.15. The average of pretty much all positive ICs is about 0.05%. So it's a very, very small, but this is what we're talking about, and that's how we make money. So basically, our ability to forecast return, return is very limited, right?
One of the most successful money managers on the planet said that you only need a small edge to make a lot of money. A very, very tiny edge, he even said. And his name is slipping me right now, but Winton Capital, David Harding said that in an interview, and I'm paraphrasing, but he basically said, we work with a very small edge, but with risk management, you can do very well. And I think that's the real key. But what's interesting though is even though you have a small edge, when you simulate it out, you actually have active returns, which are returns above the benchmarks that are 5% on average per year in this particular factor we're looking at, or something like that, if I remember correctly.
Yeah, and it goes, ICs this is the average over time, right? So it is positive. The ones we have are pushing 0.1, which is, again, we're very satisfied with those results. They go, and then you look at how stable it is over time, because not everything works all of the time. This is just the nature of it, right? Whatever style you have does not work all the time. So we know through this process, which is another outcome of this kind of analysis, is understanding very well when is your style in favor, or that factor in favor, and when does it not work? Because everything has periods or environments in which it is not expected to perform. And it doesn't mean that you have to change. And that's one mistake that many professional money managers make is when it doesn't work, they just flip, right? And then they end up doing something that they're not good at, right? As opposed to say, well, my style is simply not working right now, and that's fine. I just I should expect that period and hopefully deal with it in a bless you, and deal with it in other ways. But I can see, for example, that looking at the chart right now, and we have negative ICs for that particular percent from high factors in the 2009 era was the biggest negative. Like the IC went to negative 0.4, and it's while it was actually extremely strong coming out of 2001 was 0.4 positive, right? So you do have extremes. So you're trying to say, okay, do I have a factor that works most of the time, or what is the percentage of time that it works? So there's a lot more to this art to say, okay, how can I make this better, more robust? You mentioned anti-fragile.
Oh, absolutely. This is just one thing. Yeah. Absolutely. You have, like you said, so this factor does very, very well in bull markets, and then when you get into bear markets, you have the factor come down. You have negative ICs, but a lot of them have negative ICs actually. But a lot of factors do during those times, those bear markets. But that's basically telling you that when you have systematic risk, everything is going down, there's other things that you need to be doing rather than just blindly holding on to stocks. That's one of the biggest learnings I've had over the years, is that doesn't matter what your methodology is, blindly holding stocks can be very detrimental at times. So anyhow, but this particular one has quite a bit of consistency after the 08-09 crash. And I looked at this same factor with a different way, and I did a video. Actually, I did an interview with Real Vision on this factor last year and showed the distribution of the returns over holding periods. It basically looked at the distributions of returns day by day after the signal going out to the next year. And what you see, and it also looked at the distribution of the trades itself, and basically it has a very tight kurtosis, or high peakedness in its distribution, meaning that when you are buying companies that are closer to their high, they actually have less risk. And I noticed that in these statistics, it actually showed that too. The standard deviation was like 15 versus like in the bottom one, the bottom quintile, it was like
24.
or 24.
It's 24. I'm looking at it now. I was looking at 18 months. And that's what you want, right? I mean, it should give you more returns, but sometimes it's just because of more risk. It's the case for, if you look at a value factor, for example, that's what you'll find. You get more returns, but just because you're taking on more risk. Ideally, what we're looking for is actually a kind of an anomaly where you get actually more return for less risk. And that's what we're seeing. This
actually shows that, right?
Yeah, this is surprising. We have an improved Sharpe ratio, which we define in other video, but basically the risk-adjusted return is 0.69 in the top quintile companies and 0.29 in the bottom quintile companies. So clearly, the companies in that top that have the high value close to their highs have a much higher risk-adjusted return than all the other companies. So this is something that you want to see. Overall, it does add value versus the benchmark. So we have positive alpha, so excess return.
A lot of the value factors don't do that. They'll give you higher returns, but they'll make the Sharpe ratio worse.
Exactly.
It just amazes me why people don't look at these things as much as they should.
It is robust. I'm just looking at some stats here. It is robust internally as well, meaning that the number of companies that contribute to return inside of that quintile is above its 53%. So that basically, it's, again, those are numbers that for us are great. You say, well, that's kind of a coin toss, but you don't have to be right that many times. And now we have confidence that more than half of the companies in that bucket are contributing to beating the benchmark, and 80% of the time this quintile beats the benchmark. So those statistics that for us give us confidence, and this is just one factor, right? That's something that we're going to combine that with other things we look at.
We're just illustrating the concept of evidence-based approaches.
That's correct.
One thing I wanted to point out with this is that we talk about a small edge. The concept of asymmetry is so important, where your average win is a lot greater than your average loss. And that's another key component of this. If you were to make a hierarchy of what's the most important element to success, your accuracy of your entry is up there, but it's even not as important as to your exit, because your exit will, if you can truncate your losses so that they're not so bad, then you give yourself more of an asymmetric return payoff. So if you have an edge of 53, 55%, plus you add the asymmetry, it definitely improves the results quite a bit. One thing I noticed with these factors, by the way, is that there tends to be these technical factors, and I see this in pretty much all of them. So far anyhow, is that there tends to be a seasonality where you see it happening at certain times. I don't know if you noticed that, but it tends to peak out May, June, then it kind of comes down. And if the fourth quarter tends to not be as strong in some of these technical factors. And I actually think that has a lot of it has to do with earnings too, like when these earnings, and that'd be a whole nother study, but when these earnings reports come out, there's definitely some changes that happen during earnings reports. But anyway, so I don't want to mess up the flow here. So we talked about information coefficient. We talked about, we could look at turnover, the spread. We talked about this. I think we talked a little bit about the spread, but probably not too much. Maybe you can talk about that.
Yeah, because maybe a quick note on that is, once you have something like this and you're like, okay, this factor looks good, it seems to work. Then it's just the beginning of the work, right? The question is, there's many ways of implementing that factor into a portfolio, right? That's why it only tees off a whole series of other processes and research. The question is, okay, do you rebalance every month, every quarter, every year? Do you hold things for 2 years? That's a big question, right? Do you own, like for example, since we tested on a very large universe of 3,000 stocks, that quintile one is made out of 600 companies. Well, maybe in real life, that's too many companies. You don't want to own 600 companies, as we don't. Right. Then you have to concentrate, right? So how many companies are you? All of that is going to make you kind of make the implementation very, very different than what we are seeing in those results.
It's
Yeah.
it's just leaning the odds in your favor. It's stacking up the cards. It's like playing poker in a way. You're just trying to lean the odds in your favor. And, and you can do that with fundamental factors. You can do them with even qualitative things. Like we know that certain types of industry dynamics are positive. We know that certain types of management teams are positive. We know that, those are all things that can be added to it. But it's just like if you're a doctor, there's, the very best doctors, they look at the data, but they also have another element to how they view things. They use protocols for sure. But there's also an element of judgment that is a little bit harder, a little softer than the numbers. But
I have a question for you, if I may, because you're the technician of the group here. I'm
also a fundamental analyst.
Yeah, dangerous enough. We already discussed last week that we should turn in your CFA charter. But that's always something that you and I have a very interesting discussion about. Is this what works, fundamental analysis or technical analysis? And what we're talking about is a technical factor, percent from high, and you only look at price information and you say buy these companies and write them, right? That's essentially sounds very simple. My question for you is it that simple, or what do you think fundamental analysis can add to something like this? What is not captured in this, and what do you think is can be added to something through stocks, more fundamental stock selection?
I think the biggest thing that fundamentals can add would be an understanding about the nature of the business. And there's another layer of risk understanding when you look at the fundamentals, because you're basically saying, what are the competitors? I'll give you an example. There's a company, Viva, one of our best holdings lately, best performing holdings. There's public knowledge out there about how they have certain contracts that are out there that could generally maybe negatively affect them if those contracts go away. That's not going to show up, immediately in the price sometimes, but it will eventually show up in the price. So I actually think technical analysis has an edge, because the price actually tends to lead before everybody knows it, because there's kind of a decay with information. So that's why, technical analysis is so effective. But I do believe that if you're in tune, and the more you know about a particular stock or company or bond or whatever it is, you can have an edge in understanding those things that are not in the data itself yet, and maybe the price hasn't reflected it. The problem is information is being disseminated so fast that the price is starting to reflect things quicker. So that's making technical analysis even more effective, more important, I think. I think the other thing is you get these big, long mean reversion trends. So in the long run, value is important because it's more of a mean reversion concept than it is actually a predictor, because it's a horrible timing tool, but it gives you the general landscape as a whole, because it's basically some metric of value compared to price. And basically it's more driven by the price actually than that metric of value, because those metrics of values are more stable. The metrics of values are also late. So it's not in the reported numbers. It's not so much in the reported numbers that could help you, but it's an understanding the nature of the business in the stock perspective. What is the nature of the business? What is their competitive advantage? Are they the leaders in the industry? Do they have something that is in such a niche and such a moat, that they can have a longer competitive advantage period? I think that is super important, because that could tell you about kind of how much legs that investment has. It can also tell you about where a company is in its cycle. Where is it on that S curve, which can give you a kind of a frame to think about how you want to invest in that stock. Like, for example, if we look at a Peloton, they're in a whole different stage, and they have a less of a competitive advantage period potential than, say, a PayPal does. And when PayPal first came out, they were kind of more like Peloton. Now they're not. You know what I mean? I think that fundamental analysis, you're not going to get it in the data. But what the data, the technical data, I mean, what the technicals will show you is how PayPal went from being more like Peloton to where it is today, because all along that way, it was hitting a new 52-week high. It was hitting highs all along the way. So that's a very interesting question. What can it give you? I think it tells you a lot about the management team. You know, the management team could be really important. Are they a proven management team? Therefore, they could execute better. You know, but I think the nature of the industry, the quality of the company, the competitive advantage period, I think those are all things that that give you a longer term perspective. And then it can also give you a context about where we are in terms of, is this thing really, really overblown? Like, for example, in the financials, you've got the banks that some of the banks, you know, they're in a negative trend, but they're getting to the point now where it's like, how much longer will this last? Maybe we go into recession, it gets worse before it gets better. But yeah, I mean, so fundamental. I would never say fundamental analysis is irrelevant, and we joke about me turning in my CFA, but honestly, I actually look at all those things. I just don't talk about them as much because, you know, I think about them in terms of framing, but I don't use them in terms of selection and timing at all.
Mm-hmm. So if I'm hearing you well, and of course I'm speaking because I believe in that. So based on when we look at these results, for example, of a technical factor, and we're happy with them, we have the belief that if we overlay some fundamental analysis and selection of stocks beyond, you know, these naive kind of buckets here, we can actually improve those results from what we're seeing. Otherwise, there would be no reason, right? So that's basically what's.
I have not actually, you know what? I would like to see the data that actually shows that. I believe it because I look at it rationally and logically, but when I actually look at the data, the data that I've seen so far has not proven that adding fundamental in any way improves the results.
Well, that was my original point, right? I mean, it's like, okay, why do we care about fundamental analysis at all? And a lot of the things that, yeah, exactly. And we have a good story, right? But some of the characteristics that you talked about, management and all these things, are very difficult to backtest, right? Unless you had been doing that back in 1995, or you know, you won't have that data to say, was it actually a better decision? So, you know, these quantitative process are useful only to the extent that we have the data available to test it. Now, if we have a way to quantify what good management does, then we might be able to do it. Like you said, they're good allocators of capital, so you can look at good return on capital, good management of balance sheet. So those would be artifacts of that. But
you know,
that's the next step, right? We're going to blend those things together.
You've known me for a long time. I mean, 20 years ago, I've developed this concept of quality, value, and technical, QVT, and that was the concept. What is the quality? What is the knowability, the cash flows? What is the value? What are you paying for the metrics of value? And then is the market recognizing it? And there's that has not changed over 20 years in terms of that general way of thinking, in my mind, has not changed. Mm-hmm. I think how we implement that has changed over the years. You know what I mean? Information has changed. And that's the thing about the markets. Markets are like a biological ecosystem. They're always adapting and changing. And there's basic precepts, like if you look at evolution, there's basic principles to evolution. But if you're not adapting, then you have a problem. I mean, there's three main steps to any system, and one would be the creator, and that creator needs to actually be, you know, looking at the system in terms of how it is adapting and making adjustments. And then the other one would be the execution of it, or the, you know, kind of the pace, the day-to-day of getting the system doing what it should do. And then lastly, there's this kind of the regulator, and that's, like we talked about, regulating and monitoring a mechanism that makes it stabilized. We need a stabilizing mechanism. You put those together, and those concepts come from biology. So and there's a lot of talk about this. I know Andrew Lowe has made some analogies as well to biology, as how it relates to finance. You know, Brett Weinstein also is I get a lot of great ideas listening to people that have different disciplines than ours, but people who are scientists, mathematicians, medical people, because it applies to it's the way of thinking, I think, that really helps us. And Anyway, I kind of got off on a little bit of a tangent there. I don't know if I answered your question, but the basics have stayed the same in my mind, JP. Q, V, T. What's changed is how we implement Q, V, and T.
Mm-hmm. Yeah, no, that's that's the bottom line. And we are going to maybe share in a new discussion what happens when we combine fundamental and technical. I think would be a very interesting discussion to share, and see what happens when you combine, because you can't know ahead of time what happens when you combine two factors. You could say this works in isolation, this works in isolation. What happens when you combine them, right? So think of it as set operations, right? You have a circle here, a circle there, and when you combine two things, you're looking for the intersection. Now, is the intersection kind of the average of the two, which is kind of the average towards mediocrity that I call, or is it null setting where there is no companies that live at that intersection? So we don't know those things, right? So, you got to look at, what are these companies that have great, it's interesting right now, if we bring it down to stocks, some of the companies that are at their, 52 weeks high right now are companies that fundamentally, they have great businesses, but many of them don't make money, right? Don't have earnings. So, you could say, well, that's may not be the greatest fundamental companies from that standpoint. So you're like, okay, already the market is rewarding some companies right now that may not be your greatest fundamental looking companies, right? Sometimes I cringe when we buy stuff, because I'm like, well, they look fantastic, and I get it. I when you dive into the business, but they won't pass like your basic fundamental screen.
Yeah, if you run our QVT model on it, or the QV model on it, they won't show up, and so you have to make it's a different paradigm with those companies. That paradigm is more related towards the possibility of them actually going into profitability, and then once they do go into profitability, they have huge operating leverage, which generates enormous EPS earnings growth, and then it grows its way into it faster than people expect. And that's what happens. Like, you look at Shopify, I think might be one of those examples, because they're very close to being profitable. In our last video, I videoed out the EBITDA numbers of several companies that you had mentioned, and they were very close, and they're growing very quickly, and they're taking a big chunk. Potentially, they could take a big chunk out of Amazon. Because of the way they do business, they allow you to white label what you're doing. Amazon tends to brand their own stuff, and that was pointed out to me by one of our clients who's in the tech business. I thought that was a very important point. And these are the kinds of things that I look at fundamentally, by the way, because you have to have a mechanism to go from that top quintile. Normally when we look at our fundamental screen or our technical screens, we might have 200 companies in there. We can't own we don't want to own 200 companies, because if we own 200 companies, we might as well just own the index. We have to have a mechanism to bring it down to a smaller list. And that's why we have to use logic and statistics combined. Both a concept of using, if you remember from philosophy, inductive reasoning and deductive reasoning to actually make the choice. And, we try to use as much as possible. Whenever you're doing statistical analysis, I believe it's using inductive reasoning, because you're basically observing and making a conclusion from an observation. Deductive reasoning can be done from fundamental analysis, where you're basically, pushing things away and saying it's almost like a process of elimination. What can I know, and to what degree can I know it? And I think that's kind of how I view fundamental analysis, is more of a method of deduction and and then that can kind of help us, but it does help us to say, here's A, B, and C that we could buy that meet all of our criteria technically, but A or D is better because of this, this, and this.
Mm-hmm. Mm-hmm. Yeah, that's exactly it. I have nothing to add to this.
Well, this is cool stuff, man. This is the stuff that you and I love. So hopefully listeners got something out of it. Is there anything else that you want to talk about with regard to this? I mean, we could talk for hours about this stuff.
Yeah, we could. This is, again, one example of one particular factor. We looked at another one, that in combination, and we look at what happened when you combine them, and they did, the combination was superior to each individual one. So we have evidence. So I guess the point here is, we try to provide evidence, quantitative evidence, that everything we do adds value, and understanding why and how. Otherwise, there's not enough hours in the day for us to do a number of things that don't add value. So I think that maybe that's the takeaway here. Something to remember is, if you look at everything that you utilize in your process, go beyond just assuming that because it's cool, it adds value. Just try to prove it, right? And then if you come to the conclusion that it doesn't add value, then maybe you should question, should we do it at all, right? So we try to keep ourselves always in that state where, let's look at our process and make sure that we can document and prove that it's working. And if something stops working, then you got to say, well, is it temporary or is it permanent? And if it's permanent, then maybe you shift, and you mentioned the QVT, that's the broad stroke, but what goes inside the QVT has morphed a little bit, right? The components of it. And
a lot of them have stayed the same.
Yeah,
a lot of it is the same.
Some, and some of it is new and improved.
Some of it's new, partially because accounting standards have changed over the years. When we first started, there was a lot of simplified things, and in particular after the .com bubble, there was a big change that I remember. The concept of comprehensive income wasn't really that big of a deal. There was, how capital was really in the capital accounts and expense items. Those changed, dealing with stock options, stuff like that, and methods of accrual. And then we got the global standard that came into consideration, which changes those things. And the market is always changing, and it's also technical too. If you think about technical change, I can think about all the structures that have changed due to technology, and how that's changing how markets are behaving in the mornings, in the afternoon, and because there's rapid fire trading that's happening, how you fill is more and more important. You can get slipped around so easy now in today's market. You have to know what you're doing when you're actually placing your trades. Today was a prime example. Exiting out of a position. I don't know how we actually wound up on that. I didn't look at it, but we had quite a bit of volatility today.
Yeah, we did. We got us out just right when the market was rolling over, so I was pretty happy with that.
That's good.
But yeah, exactly. So stay abreast of don't sleep. It's a constant process, right? Once you do all of that work, you don't just put it on a shelf to collect dust. This is a living process, and you got to keep it updated and see if it's always working. Otherwise, you're going to be left behind. So,
and have fun while you're doing it.
Yeah, well, it is the fun part, actually. Innovating and doing those research projects gets my juices flowing, and I know yours as well. So there's always that aspect of innovation and research in our process. And again,
it's for the clients. It's like delivering results for clients, and I think the more and more I believe that the results for clients are more oriented towards just achieving objectives. And it's not so much, this benchmark or that benchmark. It's really like, is that goal accomplished? And did I sleep at night during that period of time? And was my experience soothing? And did I have peace of mind? All those things mean a ton to investors. Mm-hmm. And so this research is really designed around all that stuff. It's not necessarily a total profit maximization.
But it is the first step, Lou. I didn't say what is the first step of this? The first step is, what is your objective, right? You cannot design or test anything without clearly stating what is the objective. What are you optimizing for, right? Because success, everything looks good and everything looks bad. It just depends on what's important to you, right? This factor may look very poor to somebody else who, for example, I don't know what they would be looking at. This looks pretty good, but somebody who's a value, someone who's a value investor, for example, would look at that and said, no way would I buy these companies that are, look extended. You look at a chart and wow, these guys so it's too expensive for me. Well, that's inconsistent with your value, right? So yeah.
That's great. Well, hey man, thank you so much for this back test that you did. confirming our prior back tests, and we'll be doing more of these, and adding some more of this methodology to what we're doing. So it's very good, JP. Any parting words, last words? We're all good, everybody?
We're all good now.
Okay.
I hopefully that gives you a little bit of transparency into some of the things we look at. So
awesome. Thanks a lot, JP.
Thank you, Louis.